Since my 2020 market crashes video was summoned on Reddit, I thought it might be time for an update. Occasional market crashes are part of investing. Stock prices reflect investors' expectations about the future earnings and risk of the companies they invest in. When expectations or risk change due to something like nonsensical sweeping tariffs, stock prices can change, and they can change quickly and dramatically. Falling stock prices do not mean that the market is broken or that the world is ending. They are expected from time to time, and their inevitability should be built into every investment plan. I'm Ben Felix, Chief Investment Officer at PWL Capital, and I'm going to tell you how to keep a level head even when this time really is different. Let's start with some facts. Stock market declines are normal. They happen, and they happen quite a lot. They should be part of your expectations when you start investing. Looking at annual data for U.S. stocks going back to 1926, stock returns are negative in about 25% of years. Declines of 20% or more happen less frequently, but they are not uncommon. When crashes do happen, they typically recover, at least eventually. This is why your asset allocation should be informed by your financial plan. The other thing to keep in mind is that negative intra-year returns don't always predict negative returns for the year. It's not uncommon for stocks to enter negative territory at some point during the year while finishing the year with positive returns. I do think that most investors understand that market crashes can and will happen. But similar to stepping in the ring with Mike Tyson in his prime, everyone has a plan until they get punched in the mouth. It's one thing to look at historical data and see crashes and subsequent recoveries on a chart, but another thing entirely to live through one. People see past crashes and think, oh yeah, I could have gotten through that. But every market drop feels different, and the recovery never feels obvious. There's always a narrative surrounding the crash, and the narrative is scarier than the relatively abstract drop in stock prices itself. Narratives are not a sideshow. They are a fundamental part of every market crash. Economic data are boring and slow-moving, but the beginning of the end of the world as we know it due to insert crisis here gets people out of their seats and moves asset prices. To get through market crashes, investors need to understand a few things. They need to understand the historical resilience of stock markets going back hundreds of years, the power of narratives to make people behave badly and feel anxious, and they need to understand their own tolerance for risk. Let's start with some quick history. As far back as we have data, the optimists, those who have invested in stocks, have typically triumphed. Global stock returns have been meaningfully positive for at least 125 years, delivering a little more than an annualized 5% real return that is adjusted for inflation, measured in US dollars from 1900 through 2024. That is a long history of positive real returns over a period where a lot of scary stuff has happened. Stock markets have been and will continue to be volatile, and they're certainly not risk-free in the short run or the long run. It should be expected that there will be years or clusters of years with negative returns. This is completely normal. It would be weird not to have down years. The reason that stocks have positive expected returns and have had positive realized long-term returns is precisely because they are risky to own. The fact that they beat bonds and cash in the long run is called a risk premium, because getting that long-term performance is not always fun. That's the point. That's why stocks are great long-term investments for people who are able to take risk. Despite this, investors who thought they were comfortable in all equity portfolios a month ago might be ready to abandon their strategy today. Narratives probably help to explain why. In Robert Shiller's 2017 paper, Narrative Economics, he explains narratives are human constructs that are mixtures of fact and emotion and human interest and other extraneous details that form an impression on the human mind. Narratives can be extremely powerful. They can change how we interpret facts and cause us to ignore base rate probabilities while drawing parallels between our current situation and familiar past narratives. To be clear, the narrative does not change the facts of the situation, but it does change how people respond to the facts. Robert Shiller, of course, is the Yale economist who won the 2013 Nobel Memorial Prize in Economic Sciences for his work on bubbles in asset prices. Shiller defines a bubble as a social epidemic that involves extravagant expectations for the future. Bubbles are typically associated with high asset prices, but they go both ways. In the paper, Shiller explains the narratives that may have played a role in some of the biggest economic events of modern history. Take, for example, the 1920-21 U.S. recession and stock market decline. World War I had ended 14 months prior. The effects of the 1918 influenza pandemic were still lingering. The U.S. had been dealing with race riots, and a public fear of communism was growing. Combined, these were the basis for an unsettling narrative of economic uncertainty. Put yourself in the shoes of someone living through that. It wasn't just a market crash. People were losing faith in the entirety of the US economic system. It wasn't that long ago that we all lived through a pandemic that shut down the global economy and again made people around the world question whether things would ever go back to the old normal. Yet here we are. Today, we're living through a global trade war. Most economists agree that tariffs are not good for the economy, and the stock market has clearly expressed its agreement. Tariffs reduce expected earnings for companies, and trade policy uncertainty increases risk. I don't want to comment further on the narratives in this case because I don't want the comments to blow up with political arguments, but we all know why this time feels different. To be clear, I'm not discounting the possibility that this time is different, but every time is different in its own way. That's the point. That's why crashes happen. Global financial markets have seen periods of globalization followed by contraction before. In the early 1900s, there were active stock and bond exchanges in at least 40 countries around the world, and European investors, just like investors today, were being urged by the experts to internationally diversify their portfolios. That was a golden age for investing, similar to what we've experienced in recent decades. Everything changed starting with World War I. Global finance contracted, protectionism and tariffs increased, and communism and fascism saw a rise. Some stock markets closed temporarily, and some closed permanently. It was a bad time to be an investor. Will it get that bad again? I don't know. I do know that despite the rough years following the contraction of global finance in the 1900s, and including the market closures and total losses in Russia and China, global markets have been resilient, delivering positive, real long-term returns to investors. The thing is, while every crisis is unique, every time is different. Scary narratives and market crashes and subsequent recoveries are as old as financial markets themselves. The phenomenon of markets bouncing back after crashes was studied in the 2017 paper Negative Bubbles: What Happens After a Crash. The authors study crashes in 101 global stock markets from 1692 through to 2015. They identify 1,032 events where a market declined by more than 50% over a 12-month period. They find that these extremely large annual stock market declines are typically followed by positive returns. This large empirical dataset is immune to any narratives when we step back and observe it. Each of those 1,032 crashes was probably accompanied by intimidating reasons to expect worse things to come, similar to what people might be feeling today. But we have the ability now to step back and observe the outcomes of these past events, free from the accompanying narratives, to establish an understanding of the base rates, of what is reasonable to expect after a market crash based on what has happened in the past. A related point is that when stock prices do decline, expected stock returns tend to increase. From the perspective of long-term financial planning, the increase in expected returns offsets a lot of the effects of the price decline. For investors still contributing to their portfolios, this could even be seen as good news. That should make people feel better, but when crashes do happen, investors' subjective expectations of stock market returns tend to become more pessimistic rather than more optimistic. Again, a case of narratives dominating base rates. None of this means that you should do nothing. Market crashes present rare opportunities to learn about your risk tolerance. One of the often underappreciated elements of a risk profile is risk composure, how you have actually felt during past market crashes. It's worth checking in with yourself. How do you feel? How are you reacting? Are you losing sleep? If things feel worse than you expected they would when you chose your asset allocation, it might be a sign that your portfolio is too aggressive. On the other hand, if you're in a conservative portfolio, have a long time horizon, and are psychologically sailing through the current situation, it might be a sign that you can take more risk. This is also a good time to revisit your financial plan. Financial plans should be built to withstand the effects of short-term market volatility. But if a change is warranted, it's better to know about it sooner rather than later. Market crashes are objectively not fun. Narratives are a powerful component of them, and they can affect the way we interpret facts. Rather than focusing on the specifics of any one crisis, which will always be unique, I think it's important to step back and look at the broad set of data, of which we are fortunate to have hundreds of years, before responding to an event like a meaningful decline in stock prices. Regardless of the narrative, you should be invested in an asset allocation that you can stick with in both good times and bad. Getting out when things get bad is one of the best ways to sabotage your returns. If living through a stock market drop has been too painful, it might be a good time to ask yourself if you were taking too much risk to begin with. I am not saying that everything will be okay by next week. The market might keep dropping. After each subsequent drop, the decision not to sell after the previous drop might seem regrettable. Everything is obvious in hindsight. Getting out of the market might feel right today, but the second decision of getting back in is a lot harder to get right, and getting it wrong can be extremely expensive. It is true that the economy might take a tariff-related hit, but this is why you have an emergency fund. Stocks might continue to drop, but this is why you invested in a risk-appropriate portfolio. In the moment when things are uncertain, it can be challenging to make good long-term decisions. This is why you made a plan in calmer times, and now is the most important time to stick to it. Thanks for watching. I'm Ben Felix, Chief Investment Officer at PWL Capital. I hope you're all doing okay. Tell me how you're feeling in the comments.